Optimizing trading strategies using GLD.SPDR as a predictive signal for 7299.HK on the Hong Kong exchange. In this analysis, we examine the relationship between the performance of two gold-based exchange-traded funds, ETFs, SPDR Gold Shares, GLD.SPDR, and XOP Gold Futures Daily, 7299.HK. GLD.SPDR, a high-volume ETF traded in New York, tracks gold prices in the U.S. market, while 7299.HK, a 2x leveraged ETF traded in Hong Kong, also reflects the gold price but with an amplified rate of return. This unique setup allows us to leverage the U.S. trading sessions data on GLD.SPDR as a potential predictor of the next trading day's performance in the Hong Kong market for 7299.HK. By analyzing these time-offset ETFs, we aim to capitalize on early information about gold price movements when the Hong Kong market opens. Data for this study was sourced from Yahoo Finance using the Y Finance library, covering the period from June 4, 2020, when 7299.HK was listed, through to the present. After collecting the data, we cleaned it by removing unnecessary columns, such as adjusted close, low, high, and volume, which were not needed for our analysis. We then standardized the date format and calculated the daily price change based on each security's open and close prices. To align the trading sessions, we converted U.S. trading dates to Hong Kong dates and joined the data into a single dataset. For each trading day in Hong Kong, we used the closest preceding U.S. trading day as the independent variable, for example, using Friday's U.S. performance to inform Monday's trading day in Hong Kong. Since our analysis involves logistic regression, which requires categorical dependent variables, we created a flag to indicate whether the close price was higher than the open for 7299.HK, allowing us to treat its performance as binary. Finally, we split the data into 70% for training and 30% for testing to evaluate our model effectively. Our first strategy is to simply follow the signal from GLD.SPDR. If its closing price is higher than its opening price, we allocate 50% of our portfolio's net worth to buy 7299.HK at its opening price, then sell it at the close. However, due to the T+2 settlement rule on the Hong Kong exchange, there is a 2-day delay in regaining the funds from each transaction. To assess the effectiveness of this strategy, we will also record key statistics, including the number of trades, profitability rate, and overall returns, providing a basis for evaluating and refining this approach. The simulation begins with an initial available fund of 10,000 Hong Kong dollars. By the end of the second trading day, the portfolio's net worth rise to 10,003 Hong Kong dollars and 34 cents due to a 50% allocation, $5,000, to 7299.HK, which increased by 0.0668% that day. The proceeds from this sale will not be available in the account until July 12, due to the T+2 settlement rule. The simulation continues in this way, tracking each trading day up to the most recent date available from Yahoo Finance. To contextualize these results, we introduced two control experiments using GLD.SPDR and 7299.HK. In each control simulation, 50% of the portfolio's net worth is used to buy at the open and sell at the close for every trading day. This approach provides a benchmark for evaluating the effectiveness of our initial strategy by enabling direct performance comparisons across each trading environment. Both GLD.SPDR and 7299.HK trade every day while the raw signal trades only about 47% of the time. This lower trading frequency of the raw signal strategy could indicate selectivity based on certain conditions in GLD.SPDR, making it less consistent but potentially more targeted. The raw signal strategy shows a higher chance of profit per trade, 58%, compared to GLD.SPDR, 51%, and 7299.HK, 49%. This suggests that even with fewer trades, the raw signal approach generates a higher win rate. Raw signal outperforms both GLD.SPDR and 7299.HK with a rate of return of 8%. This is notably higher than GLD.SPDR's return rates, and it stands in stark contrast to 7299.HK, which incurs a negative annual return rate of -2%. All three strategies aim to buy with 50% of the portfolio's net worth per trade. However, because GLD.SPDR and 7299.HK trade daily, they are subject to T+2 settlement, meaning the funds from a sale aren't immediately available for reinvestment on the following trading day. The raw signal and 7299.HK have similar levels of volatility, with raw signal at 5% and 7299.HK at 6%. GLD.SPDR is much less volatile at 3%. Next, to quantify the relationship between GLD.SPDR's performance and the likelihood of 7299.HK rising the following trading day, we'll employ standard scalar to normalize our input data. By scaling the data to a standard range, typically with a mean of 0 and standard deviation of 1, we ensure that each feature contributes equally to the model and avoids bias from differing scales in the dataset. This standardization step is essential for models that rely on distance calculations, such as logistic regression, as it enhances model accuracy and interpretability by making coefficients comparable across features. With the input standardized, we'll be in a better position to examine potential predictive relationships between the two ETFs. Class distribution. The dataset is fairly balanced, with 389 instances of false and 347 of true for HK_FRIs. This balance is beneficial, as models trained on unbalanced classes often perform poorly on the minority class. Precision. Both classes have a precision of 0.60, indicating that 60% of the model's positive and negative predictions are correct. This moderate precision suggests some predictability but shows room for improvement. Recall, the model captures 71% of the false class but only 46% of the true class. This imbalance implies that the model is better at identifying instances where 7299.HK doesn't rise than instances where it does. Increasing recall for the true class could make the model more useful in practice, especially if predicting price increases is a priority. F1 score. The F1 score for the false class is higher, 0.65, than for the true class, 0.52. This score, a balance of precision and recall, indicates the model is slightly better at predicting when 7299.HK will not rise. The average F1 score of around 0.60 suggests the model has moderate predictive power. Overall accuracy, with an accuracy of 60%, the model performs moderately better than random guessing, which would yield around 50% accuracy on this balanced dataset, but has significant room for refinement. With the formula to calculate the probability of 7299.HK rising given GLD.SPDR's change, we can now apply this model to the merged dataset to obtain the predicted probability for each trading day. This calculation allows us to assess the likelihood of 7299.HK's performance on any given day based on GLD.SPDR's behavior. In our next simulation, the strategy involves buying in with 50% of the portfolio's net worth whenever the predicted probability of a rise in 7299.HK exceeds 50%. This threshold equates to an approximate 0.115% increase in GLD.SPDR. By using this probability-based approach, we aim to align trading decisions with days that have a higher likelihood of profit according to the model's predictions, potentially enhancing returns by targeting only those days where GLD.SPDR's performance suggests favorable conditions for 7299.HK. Profitability and return. The logistic regression strategy shows a higher annual return rate, 9%, than the other approaches, indicating that the probability-based model contributes positively to portfolio growth. It also leads in the chance of profit per trade, 63%, surpassing the raw signal and significantly outperforming 7299.HK. Volatility, regression. The volatility of 4.33% is slightly lower than that of the raw signal, 4.59%. A lower volatility indicates a potentially smoother equity curve, making this strategy less prone to dramatic fluctuations in value. With an objective measure in place to signal when to trade, the next step in refining our strategy is determining how much to invest each time. Here, the Kelly criterion provides a systematic approach, allowing us to calculate an optimal betting fraction based on probability and odds. To apply the Kelly criterion, we need to establish both the probability of success and the payoff odds. We'll calculate these odds by comparing the average returns for trades where a rise was predicted and occurred, against those where a rise was predicted but did not materialize. This way, we can determine the optimal fraction of our portfolio to invest on each trading day, maximizing long-term returns based on the model's predictions. In the chart above, we observe that this strategy initiates small buy-ins even when the predicted probability of a price increase is just below 50%. With this setup, our next step is to run a simulation that applies the optimal betting fraction on each trading day. This approach allows us to adjust the investment amount based on the Kelly criterion's recommendations, fine-tuning the exposure in line with our predicted probabilities and optimizing potential returns. Count of trades and trading frequency. The Kelly criterion has a slightly higher number of trades than the logistic regression strategy and raw signal. This reflects the flexibility in trading decisions based on optimal betting fractions rather than strict buy/sell triggers. Rate of return. Although the Kelly criterion yields a lower annual return rate compared to logistic regression, it does so with less aggressive capital exposure, achieving a competitive performance by only using a smaller portion of the funds available. Average return rate per trade. Kelly criterion has the highest average return per trade at 0.27%, which shows that the method effectively captures profit per trade while managing risk with smaller, more calculated investments. Volatility. The Kelly criterion exhibits the lowest volatility, indicating it achieves more consistent returns with less fluctuation. To further enhance our strategy, we plan to run additional simulations using the Kelly criterion with different multipliers. Given that the rate of return for the initial Kelly criterion simulation was lower than that of the logistic regression strategy, these simulations will help us identify if adjusting the multiplier can boost performance. By experimenting with varying bet sizes, we aim to optimize the Kelly criterion approach and potentially increase overall returns while maintaining effective risk management. The chart above illustrates a risk-return curve for different Kelly multipliers, with the highest return achieved at Kelly 7. Notably, the volatility for both the raw signal and logistic regression strategies aligns closely with that of Kelly 3. However, despite the similar risk profile, both raw signal and logistic regression yield significantly lower rates of return than the optimized Kelly multipliers. This suggests that increasing the multiplier enhances returns without substantially increasing volatility, up to a certain point. Finally, we conducted a simulation using the Kelly criterion with a multiplier of 7 to evaluate its statistical performance. The stats show that the Kelly criterion 7 strategy achieves the highest annual return rate, 13%, among all strategies tested, surpassing the returns from the other strategies, and the baseline Kelly criterion 1 strategy. While the chance of profit per trade for Kelly 7 remains comparable to the other strategies, at 60%, it achieves this with fewer trades, 48% of the time, suggesting more selective but potentially higher stake investments. The volatility for Kelly 7, at 6%, is notably higher than raw signal, logistic regression. This suggests that while Kelly 7 offers the highest potential return, it also introduces a greater level of risk, as seen in the higher variability of returns. The average buy-to-net worth ratio for Kelly 7 is 35%, which is relatively moderate, lower than raw signal and logistic regression but higher than Kelly criterion 1. This ratio suggests a balanced approach to position sizing compared to the original Kelly criterion. While it doesn't fully maximize position sizes, it maintains a more conservative allocation than other aggressive approaches. Leveraging additional securities, we could expand beyond 7299.HK to other Hong Kong securities, potentially benefiting from other ETFs that track the reverse performance of gold prices, like 7374.HK, which was delisted in May 2024. Utilizing both rising and falling signals could optimize profitability across varied market conditions. Leveraging additional securities, we could expand beyond 7299.HK to other Hong Kong securities, potentially benefiting from other ETFs that track the reverse performance of gold prices, like 7374.HK, which was delisted in May 2024. Utilizing both rising and falling signals could optimize profitability across varied market conditions.